Welcome to the late night Hidden Edge podcast show. Man, we don't need no introduction. What's up, Chris Patel? I'm Sam.
We need to
Again,
get an
don't need an
intro,
introduction,
man.
but yeah, I know. Nah, we don't need no intro. This, come on,
Make
we're
this
gonna
somewhat
keep it real. We're gonna keep it
professional,
real.
man.
No,
We
man,
gotta
this
keep this.
is super professional. Super professional.
No,
So
yeah.
I got some bad news. Is that actually no? I got good news. Is that I'm going to be stepping away for about 15 minutes. And
That's
Mr.
right.
Chris UNH Patel is going to be taking the helm, probably talking some macro and all that nice stuff. I will be back in 15 minutes, guys, and then we're going to continue on with the show. But I'm going to leave you guys in really good hands
All
because
right.
I'm going to leave you. I can leave you to the co-host, Mr. Chris Patel. All right. So actually, Chris, are you going to share your screen or anything?
Probably not. I'll just talk to the crowd for a little
Okay.
bit, and
All
just
right.
answer questions in the comment section. So, yeah.
Don't ask
Go
Chris about
ahead,
the
man.
data center stuff. Don't ask him about the data center stuff.
Yeah,
He's
yeah.
not going
Don't
to
ask
tell
me
you
about
what you
data
want to
center.
hear.
I don't really care about data centers.
Yeah.
So just don't ask me about that.
All
But
right.
go take care of your daughter. Go.
Yeah. I got to take care of my daughter. All right. I'll be back in a minute.
The joys of being a parent. So, before anyone asks, Sam is going to go put his daughter to bed. Me, I don't have any kids, so I'm here with y'all. Um, all right, so I guess we'll kick it off pretty much just talking about some of the events that are happening day to day. Right now, one of the biggest things that happened today was the government shutdown is finally over. Um, I think this was something that the markets, even though it was like, hey, governments will eventually open, the market was looking for some sort of clarity on when they would open and then what kind of deals would be made by the Trump administration and how everything would go. Now that it's open, I think not not necessarily from just the money flowing back through the economy will probably help, but also a lot of these federal workers who haven't got paid in about a month now, they're going to have spending money right around holiday time and they're going to get a nice little chunky bonus. So that money will kind of flow into the economy, and hopefully we'll see the impacts of that during the Christmas that's coming up. The other thing is a lot of the data that we kind of missed out on. Some of that data is probably going to be coming out. Some of it, from what I've heard from Carolyn Levitt, the press secretary, she said that the data may never be available. So we'll see along the lines of what that happens. But when the markets are this tied to the economy, where you kind of want to know, like, okay, what the Fed is going to do in order to plan for next year. One of the things that we're all always looking at right now is that inflation data, that unemployment data, and that's the thing that I think the markets are going to really appreciate going forward. So for me, I have been trying to look at data that isn't government based. If you look at the government data, it's usually lagging anyway. So, if you look at like unemployment reports from the ADP on jobs and payroll numbers, and also some of the spending from credit card delinquencies and everything else, we can sort of see that the economy is weakening, right? And the Fed is in a good place, in my opinion, right now to keep cutting. If you guys look at Polymarket, you can see that there's like a 70% chance of a rate cut in December. So I think the rate cut in December is almost guaranteed at this point. There was a couple of comments by Fed officials that there might be a pause, and so it's still not 100% guaranteed that we're going to get that December cut. But in my opinion, I think majority of the board is probably leaning towards a cut, especially if the numbers, the jobs and payroll numbers come up to be a lot more lighter than people are thinking. So when it comes down to it, I think inflation is sort of already on this massive decline, but the data itself is lagging, which just means to me, when I look at this, it's like we're probably going to get the December cut. And I know the market's currently forecasting 2 cuts in 2025, 2026. We might actually see 3 or 4, right? And so that part of the inflation narrative isn't necessarily baked into the current markets and valuations just yet. So, we'll see what happens. But as far as I can tell, I think we're going to have a pretty good next 2 months. Some of the comments, one of the things I think is very underappreciated when it comes to like these YouTubers, like even Ahmed and all these guys, they don't read the comment section nearly as much as they should. You know, like the one thing, like I'm thinking about like launching a YouTube channel specifically so that I can actually focus and talk to you guys from the chat, because I think the chat, you guys you're supposed to get some importance out of it too. So let me just start at the bottom and I'll kind of work my way up. Let's see. I don't know much about Iran and Nebius, to be honest with you guys. Like, it's not really my forte. That's really Sam. Like, Sam does a lot of the research. He's also in the tech field. Well, for me, I'm in the kind of the outer fringes, so I can't really say much about it that could add any value. What are your thoughts about data for October jobs and CPI being blocked? How does that impact the end of year rally? I think I think the numbers are not the worst, but they're not the greatest either. And I think the press secretary also said that there might be a little bit of a hit to GDP in the fourth quarter, specifically because of the government shutdown. So I don't know how true that honestly is going to be. I think that's a really big negative revision, and to trying to put blame on literally like a government shutdown. I don't know if that's necessarily something that I would go with. But I do think that we're going to have a pretty good next like 2-3 months. So it should be pretty solid. Discretionary spending boom. You're absolutely right. I think that there is going to be a discretionary spending boom. There is a video that I will show to you guys once Sam is back, because I can't approve it. So, but if you guys know the former chief economic advisor for Trump, Gary Cohn, very smart guy, former Goldman Sachs. He basically said the same thing, that you're going to see this pent up those pent up wages kind of come into the market all of a sudden. And so you get this lumpiness, but then we're going to be on the other side of that lumpiness, where people are going to have that discretionary income of saving that they're going to be able to kind of dump into the economy via spending for Thanksgiving, for Christmas, and everything else. So that should theoretically create like this boom that should last us into December. So we'll see what happens with that. Didn't say to thank you for your service yesterday. Yeah, I appreciate it. For those that don't know, I was in the military. I did that after college. Needed like sort of a change of life um, thing, and I've watched a lot of movies really early in my life, and kind of wanted to do my part and serve. So it really, I think it was one of the best decisions I ever made in my life. There are stories that I still have from my time that to this day probably have crafted me into who I am today. So there's a lot of things I didn't know about myself before I joined the military that I realized afterward. Like, I guess the biggest thing that I learned, to be honest with you, was I realized that I wasn't made of glass. You know, when you're in the military and you're doing, especially like during basic and AIT, when you're really pushing yourself to like the next level when it comes to physicality, you really don't know how much you can tolerate until you go through it. And then once you get past it, it's like, wow, that wasn't nearly as bad as I thought it was. And for anyone who was in the Army at any point, I went to Fort Knox for basic training, and it was still an all male basic back then. Um, I did agony, misery, heartbreak. There are these 3 giant mountains over at Fort Knox. They're rough. And yeah, it was good times. It was good times. I was a combat medic. So if anyone's wondering, a 68 whiskey. Hey Chris, Supreme Court strike down tariffs. What do you think the markets would react? Uh, I think it would react positively, only because the tariffs do add to some cost, but but I don't think it's nearly as big of a, oh my god, like, yes, everything is going to be great all of a sudden moment. So I don't know. I don't necessarily think that that it's going to be that big of a deal, only because there are certain tariffs that the Trump administration has been able to kind of put on. There are other ways that they can go around it and keep the tariff regime going. So the Trump administration is going to do everything in their power to make sure that they hold the tariff cards in their pocket. So I'm not necessarily like overly concerned with the Supreme Court issue with the tariffs. I'm more concerned with what is likely to happen in the midterms next year. And this is something that I kind of spoke to on Amit's channel last, I think 2 weeks ago, about the bottom end of the consumer is in really, really weak shape. And that's bad because a lot of those people are in like this pissed off mode, and they'll vote for anyone who says that they can kind of relieve the current malaise in the economy that's impacting them, right? So that's why you got the likes of Zoran Mandami winning in New York. So, you know, when it comes to the midterms, the Democrats are going to do everything in their power to paint Trump as the guy who could not live up to his promises with controlling inflation. So if you guys noticed today, when Trump finished signing the bill to reopen the government, the first things that he mentioned was affordability, affordability, affordability. And I think that's the key thing that we have to look at next year as to how we can get people back to a place where they can afford things again. And I think it has to be a combination of higher wages and lower prices. Now, sometimes people think like lower prices is bad because it's deflationary. And I'm like, well, if the general market is deflationary, it's bad. I agree. But there are times where pockets of deflation are not bad. As an example, is anyone here complaining about lower gas prices? No, you know, like if anything, lower gas prices means cheaper input costs for everything else. So that means that the economy will kind of get this boost. So you kind of want energy prices deflate. No one is saying and begging like, oh my God, I wish electricity prices were higher so the economy is doing better. Like, no, if you have cheaper electricity, that means that, you know, all the input costs that go into manufacturing, they go down. So you always want to have policies where input costs are going down as much as possible, and those are things that that the administration is really going to have to push hard on for the next year, especially prior to the midterms. Because if they go into the midterms with the current narrative being that inflation is still bad and it's on the brains of most people, then the Republicans are going to get slaughtered on the Senate and the House, and then the Trump administration is going to end up in the same place they were prior administration, where they're going to end up being, being a lame duck, and no one wants to be a lame duck because at that point, everything that the president does goes through the filter of Congress, and it's like I said, nothing gets done, and sometimes nothing getting done is actually good for the economy, but then you don't want to have so much contention that nothing gets done in a bad way. As an example, like one of the things I'm really looking forward to and coming up is a lot of crypto legislation where the U.S. is trying to really become the primary conduit for stable coins around the world, so that this way we can get demand for treasuries up. But if right now the U.S. is not able to get that legislation passed because there's an impasse between the president and Congress, then that's just something that we're going to have to keep delaying for no reason, even though both parties agree that we do need, you know, some level of legislation around shut up, don't laugh. I think I was just
No,
talking. I felt like I dude, you know what it took me to look at myself and just talk, because it was
I don't
so weird.
know.
Like,
What's
huh?
the issue with that? Like, you're not just talking to yourself, you're talking to everyone. Oh, yo, what's up? It's Sachin. Did I pronounce that correctly? My bad if I. Hey, yo, why don't you
Sachin,
come
yeah.
on the YouTube channel, dude? Come on the YouTube channel. The biggest PayPal bag holder in the world is about to join the YouTube channel chat. Just kidding around. I like that guy. I like that guy. Ahmed calls him
Yeah.
out a lot. He's doing pretty good. He's doing pretty good. Let me actually bring something here. So yeah, my bad. I hope the audience enjoyed your time. This is messed up. What do we where's a real host? This is a co-host show, the Hidden Edge podcast. We're in episode 44 right now. 44. We've been doing this for a year now. And
Yeah.
it took a little bit of a hiatus for a minute. But you know, we're trying to get back into it. Unfortunately, we both have lives. That's a very unfortunate part.
I don't have a life,
Other,
dude. I basically work. I go to like my bed. and I'm literally just researching, and then I'm going back to sleep, and I'm coming. Like, it's literally my entire existence is about 3 rooms. I usually go to either I'm in the bathroom, in the kitchen, or in the bedroom, or my office, and that's about it. Like,
Well,
it's bad.
I'm a slave to my kids. Like I'm a permanent chauffeur, permanent ass wiper, permanent. Like I'm just a slave to my kids. And to be completely honest, I don't mind it. So
Yeah.
I mean, I joke around a bit. But I enjoy it. I enjoy it. It's really cool seeing your kids grow up. But yeah, I mean, honestly, sometimes like I do wish I had more time to like do the research in stocks that you guys can do, and I don't have the time for it. So I really got to like hone in on like certain things that I know. Otherwise, I'd be like all about this Fiserv and stuff, the VG. But sometimes some of those positions just like set it and like forget it and like just hope it works for really long term holds. Planning to start a vacation now, and we'll be back in action in January. I will definitely come, buddy. Yeah, man. And when you come back in January, PayPal will be over $100, hopefully. I don't understand why that stock is still trading in the same place as like 3 years. I understand the margins. I understand the turnaround ship story, but the buybacks, the EPS
Dude,
growth and all that stuff, like it makes no sense
it's
to me why that's getting bid up and Oklo's getting bid up, other than the fact that it's just sentiment. It's just sentiment on it at some point. But
no, I mean,
yeah.
you gotta here. Let me share my screen real quick. This is the one wake up call that I think I want to deliver to the PayPal community. Not to say that it's not a good investment, but let me wake you guys up, okay? A lot of time. Oh
Oh,
shit, my bad. Wrong screen. Wrong screen. There we go. Share screen. Hold on. Upload entire screen. This one. Okay. So I'm gonna I this is not to insult any PayPal people. Let me just start there. This is just trying to explain and reason with you guys to just show you, okay, why what is actually happening. And believe it or not, why PayPal will likely do well going forward if they make some serious changes. So the first thing you have to look at for any business, okay, is just revenue growth itself. When you are a growth company, you cannot go from 25% revenue growth to growing at 4%. This is not right here. This does not mean you get more than a 15x multiple on your P. I don't care how much you are buying back your shares. If the value of your PE is like 20, if you have a 20 PE company and you're buying back shares, you are destroying value for shareholders because you are going to go down further and further as your revenue growth rate keeps going down. Now, here's the thing. If your revenue growth here was 8% and it's stabilized at 8% and you have a 20 PE multiple, absolutely makes sense because now what's going to happen is it's actually value accretive to you. PayPal, on the other hand, they're not growing their business. All they're really doing is buying back their shares, which I totally support. I think that they should be buying back their shares, but they also need to focus on this revenue growth number. And unless they get that revenue growth to start reaccelerating, right? They are going to get a very low multiple. Now, here is the kicker for you guys, and this is something that you guys should keep in mind. Growth is reaccelerating, but it hasn't made a trend that is durable just yet. So you see this V-shaped recovery in growth. This is something that's actually really good. So for people like me who sold out of Palantir very early and made that mistake, this is something to learn from. If these guys can grow and get their growth rate to be a durable 7, 8, 10% and literally accelerate this way, then the value of this company is actually going to come through in its stock price, right? The other thing is when the stock was around here in 2021, their market cap, their ratio, let me just show their PE ratio real quick. Sorry. Their PE ratio right here. Their PE ratio at the time was almost 100. Okay. So when you have 100 PE ratio and you're slowing down, that is a major, major problem.
well, I mean
Here.
that was a different time.
Right. Now, here's the thing. the PE came down significantly, right? Because of all the share buybacks and everything. And now it's trading at a 13 PE. So even at 13 PE, this is not like, oh my God, the greatest growth story in the world anymore. So a 13 PE is more fair value than it is undervalued. Like no one is saying to themselves, yeah, I'm going to buy a business that's growing at a single digit and I'm still going to pay more than a 10 to 15 multiple, right? So if anyone here is thinking that, oh my God, this thing is aggressively undervalued, you're kind of in the right place that it is undervalued relative to the share buybacks. But the impacts of the share buybacks are going to be felt most now. So the question here is, are they going to be able to kind of maintain that V-shaped recovery in revenue growth, and what are the ways that they're going to be able to do it? A lot of businesses, if you look at Adobe, you look at Salesforce, the same exact thing happened. Their growth rates went from 20% plus to 10. So when you get a 10% growth rate, even if your margins are expanding slightly, you're going to get hit.
I
Okay?
agree.
So
Unless
so
you're like the leader of like cloud, or
right.
maybe
But
you're the leader of a search engine. Yeah, no, I get that. I get that.
And that's exactly why these companies, what they tend to do is acquire other companies that have much higher growth rates. And believe it or not, they don't even have to be profitable. Like you look at something like let me choose, like Tableau. I don't even know if Tableau was profitable at the time when CRM bought them. Like look at Figma before they IPO'd. They were still negative cash flow at the time. But Figma was growing at a really fast pace. The challenge that you run into with a lot of times when you're a really big company like this is that you are not in the position to acquire other companies because you might get hit with antitrust and all this other stuff. So my thing with PayPal right now is if PayPal looked at some other businesses that are out there and said to themselves, man, you know what? We have all this strong cash flow. Instead of just buying back shares, let's buy a really strong business that's growing really fast, that's desperate for cash for growth. Because we have the cash for you to grow, and we're going to be able to help you with that. So if a company right now is borrowing money from the debt markets for, let's say, 10, 12% from a PE firm, but it's growing at 25, 30%, right? It's not cash flowing because most of the cash is going to interest. Then you get an automatic boost if you were to buy them. And now on a blended revenue growth rate, your revenue goes the other direction. So in my opinion, PayPal needs a really good acquisition, and I think if they really wanted to, they should get into the prediction markets. And they should get into the brokerage game. Buy Webull, buy Moo, buy something that's gonna
I
give you that growth, man.
I'm not. I. This is where I disagree with you. I am not a fan of buying second-rate winners, because the market will never be in favor of them until the leader falls off a cliff. And few examples that we've seen, is you mentioned Webull, and even though Webull is doing well in terms of the business, it's growing. Robinhood is just the candid leader in that space, and it'll never get the premium it's supposed to. And in my opinion, I think, like, when you think of like SBET and BMNR, to be honest, I'm not like a total expert when it comes to exactly how these treasuries work. Um, the Wall Street will always give BMNR the premium. And if there's a rotation back into Ethereum, which we're kind of looking a little bit overnight, the reason why the actual shutdown of the government is we're actually seeing the rally back in Bitcoin, I just don't understand. But anyways, you're always going to have the leaders just continue to lead in this case, right? So if you look at Palantir versus Big Bear AI or whatever competitors there are, like Palantir is always going to have the commanding lead in that. You look at Alibaba versus Amazon. Obviously, there's a very big difference in terms of a revenue stream and in terms of, I wouldn't even say operating income, because Alibaba is actually a pretty profitable company. But besides the fact that they're in China, like Amazon's going to have the commanding lead. You look
I'm
at
I'm I'm gonna
JP
disagree.
Morgan and Bank of America. You look like just
No, no,
every single time. Yeah, go ahead.
I'm gonna push back a little bit on that. There
Push it
are
back, buddy.
multiple.
Push it back.
The reason why I'm going to push back on it is because even if there is an industry, as long as you can scale, right, you can have a disruptive way to basically grow your business. As an example, the same argument that you just made, well, Robinhood is clearly the winner. Do you know who used to say that to me? The Charles Schwab people and the Fidelity people 4 years ago. 4 years ago, IBKR people too. Why do we need another brokerage? Like, what is the point of Robinhood?
Okay,
We don't need that,
there
right?
is
No, no,
no way Weeble's going to catch up to Robinhood. Just
no, no, no.
no way.
Listen,
No way.
listen, listen.
But the
All
value
I'm trying,
meter version, maybe.
all I'm trying to say is we cannot be in this position where we say to people, okay, the second player, the second fiddle is never going to be and I'm not, and by the way, you don't, like, Weeple does not need to get the same level of what is that thing called, attention that Robinhood does in order to get a really strong business. Like, look at IBKR, right? IBKR is a very strong business. Just because Robinhood is on the growth path right now doesn't mean that everyone should sell their IBKR. I mean, if you look at IBKR over the last last 5 years, even while Robinhood has been growing, look at IBKR, Interactive Brokers. Look at that. Okay, so they went from $9 in 2021
They had a
to
split.
now being
That's right.
almost,
They had a split.
yeah, and then now they're worth $72.
Yeah.
Right? So it's not, I think this industry itself is growing at a very fast clip. And one of the things I like about Webull, right? And I'm not saying everyone should go all in on Webull, that Webull is the next Robinhood. That's not what I'm trying to say. I think this entire industry with brokerages is getting bigger and bigger and bigger. The total addressable market for this thing, Sam, is huge. I'm telling you, the experience
for sure.
The experience that really set the tone for me was, I told you, I was with Matt, and I was with one of our followers. His name is Fool's Gold. His name is Zach. I'm not going to give you his last name, but personally, I don't know his last name. But his wife or fiance or girlfriend she was sitting next to me at dinner, and she was showing me on the brokerage app that she had in Mexico, like, about investing, and she was completely new to investing, right? I thought to myself at the time, like, wait a second, hold on a second. Like, you're starting to see this level of penetration in investing and doing things on the phone outside of the United States starting to gain traction. Okay. If you look at the United States, I think right now there's a good chunk of people that are currently on, that own stocks and, all this stuff. And a lot of retail investors, their conduit has been Robinhood. The thing is, if you look internationally, the penetration of brokerages is huge, but it's growing at a really fast pace. It's not that big right now in a lot of countries. So Webull right now is doing its part to grow everywhere. They're gaining subscribers, not in the US as much because Robinhood really is the dominant leader, but they are expanding everywhere else. So I think this total addressable market is actually big enough to the point where you don't necessarily need to be in the number one company. You can be in a nice, safe number two that's growing along with the others. Like I said, if you were in IBKR, you made money. If you were in Robinhood, you made money because the general market is just getting bigger, bigger, and bigger. So when I look at the companies that are in the space right now, let me show you the watch list that I have for brokerages. Let me see, where's my brokerages thing? Sorry, guys, I have watch lists on here. Brokers. Okay, here are 4 main brokers that we have. We've got Interactive Brokers. It's a $123 billion company. Charles Schwab is a $173 billion company. Robinhood is a $120 billion company. Webull is a $4.8 billion company. And I think they have almost $1 billion in cash. Okay.
But
And there
how
is
fast is Robinhood growing?
No, I totally agree. Robinhood is in super growth mode because Robinhood is also attracting a lot of people in other segments, like what they call, like, the crypto trading thing at the same time is growing. They
Yeah,
also have the
they have
prediction
multiple
markets, which are
verticals.
lending into it. And I
Well,
agree.
I would argue that IBKR probably is a much more robust platform than Robinhood, like by
Right,
far.
right.
The problem is that IBKR doesn't have Vlad Tenov as its CEO, and they're not running multiple summits throughout the entire year, and Wall Street isn't like dead in love with the company. That's the problem. That
Right.
is the reason why Robinhood commands its premium. Of course,
And
its fundamentals are
yeah.
great. Of course, it's growing and everything, but like that is the reason why.
Right. But the key to what I'm trying to just say is that with regards to this growing pool of people, even if Webull was able to capture a very small portion of that gigantic pool of people investing in the markets over the next 5 to 10 years, this company has a lot of ways that it could grow alongside this entire business. That's what I'm trying to say. So it's not to say that, oh my God, Webull is all of a sudden going to surpass Robinhood or is going to surpass Charles Schwab or Interactive Brokers. I'm not saying that. All I'm saying is look at the discrepancy between valuations on the brokerages. And here's the thing, and this is the part when I'm doing my research, there are a good number of people that are very, very, very much in love with Webull, and they are Webull loyalists. Do I think that the CEO of Webull is a little bit less not little bit, a lot less active than someone like Vlad Tenev, who just is a very charismatic, dynamic leader? 100% agree. Vlad Tenev, this dude is doing everything in his power to reach out to his retail community, doing crazy, crazy good work in getting growth. And I do think that under a better leadership, Webull could actually do well as well. But at the same time, I'm just looking from a fundamental standpoint. Hey, wait a second. Like there are a lot of people that use Webull. Okay. And if they're able to monetize at even a remote level that Robinhood can, you could see this thing double, triple, and quadruple in a few years. I'm telling you, this is the same arguments that a lot of people said about Robinhood when Robinhood was trading at $7, saying, "Who the hell needs Robinhood? We've got Fidelity, we've got Interactive Brokers, we got Charles Schwab, we've got Ameritrade. We don't need another broker." I'm telling you right now, this entire industry internationally is growing, and it's growing at a very fast pace. And if these guys, like I said, can pick up even a small percentage of it, this is a company you want to look at.
All right, so I think I don't think we're ever going to agree on this topic, so let's just leave it at that because I'm going to give my argument, my counterpoint, and we got more to cover in the show. But I'm going to stay along Robinhood, and
Yeah.
I'm sure Webull is going to work out. But like I think when we're arguing in terms of like Webull doing good as a company,
Yeah.
probably, but just the commanding lead of a premium in the stock market is going to be on Robinhood
Yeah,
until the
not
floor changes.
I'm not disagreeing that you shouldn't invest in leaders. I totally agree. And investing in the leaders is the best way to get alpha. But you know
Yeah.
what? There's another company right now that's not a leader, like AMD, that has been doing really well in the shadows of Nvidia, right? So the key is, yes, you should look at the leaders as a primary way to invest, but at the same time, look at the other guys that are living in the shadows. Because I'm telling you, one of the things I really like about being that number two that's not getting that valuation premium is that they can learn from the leader and actually outpace the leader at times, because the expectations of the leader become so big, right? That they're not able to kind of like pick the little things that
Yeah.
are there. And not to mention the little guys, they almost have like this roadmap of what to do. So like Webull's been doing that. Webull's been like this little chaser, but what they do is, oh, like what is that thing called? Robinhood adds crypto, they add crypto. Like Robinhood added prediction markets, they added prediction markets.
Yeah.
So like I said, they don't have to be the winner. But from a shareholder standpoint, you're looking at investing in a company that's $120 billion versus a company that's only $4 billion. What is that? A like fifth, like how much, what percentage of that is the market cap?
Yeah. It's like 2% of the market cap. Okay, so but let's okay, that's it. This debate is over. Like this is just not going to. We could spend the whole show talking about this, and we got to
Yeah,
get to the stuff that we brought up. So, guys, I hope you enjoyed Mr. Patel. Did you talk about Fiserv?
not yet. Not
Okay,
yet. I
okay.
was
So
going through the economy.
let's go back. Okay, so you already went through the crack situation. So we already got that covered. Just to cover the technicals real quick. of what Chris is discussing in terms of the macro. Why don't I bring up my charts and you can go ahead and just like give me the quick 411 of like the top level of like what you're discussing in terms of macro in like 20 seconds. And then I'll bring up the charts to cover the other side of the markets and why this morning I thought some cracks are forming, but I mean, looking at the overnight markets, it doesn't really seem that way. So go ahead.
Yeah, I mean, I think right now we're due for a Santa Claus rally that's coming up. If we just look at like the bullishness from the general markets with regards to now everything starting to become more clearer with what is this thing called with the government's finally open again, I think that's going to help boost spending in the next couple of months. So a lot of the demand has been kind of like held back for the last like 40 days. And so now that consumers are going to get this boost, I think we should see like money and liquidity flowing back into the economy again. So when we see that and valuations have kind of dipped a little bit, not a lot, but they've dipped a little bit, I think that there's going to be a lot of people doing chasing.
Yeah.
You know, and that
Check this out. Did you see this? Did you see this post from the freaking White House?
Don't
bet
against the Trump.
I don't know who is running this account, but
by the way, there's an echo because I think you're recording. You're showing.
Oh shoot! Hold up.
Yeah.
Still?
No, not anymore.
Oh,
well, yes, still here.
God damn it! Hold on.
It's amateur hour tonight.
Okay, still?
No.
Okay, good. No. Yeah, I was gonna say like, okay, so I'm not managing this account, but if I did, I would probably do this post. But I just think it's like really funny how they're running the White House account like it's a freaking like it's some sort of meme account. Anyways, all right. So just to cover the other side of it, let's start from the top. Let's start with SP 500 futures or ES. Actually, let's go a little bit more top level. Let's just do SPY. All right. There were a few things that happened last week. One, we retested the 50-day moving average. We actually went below it and we recovered it. All right. That's a very bullish sign. Anything that I've done in terms of hedging, like I closed when I saw this. And in fact, I added some exposure. And now we're above the 20-day moving average. And dude, are you kidding me, man? Basically I sold Michael Burry the puts that he bought. That's what I did. So anyways, I think I agree with you. I think we're going to get a crazy rally from here. We're literally flipping from fear in the markets where people think the markets are just going to roll over. And the reason why is because if you look at SPHB divided by SP.
I don't think you put the division.
SPHD divided by SP low volatility. Yeah, low volatility. No, okay.
You put SPHB, not D.
No, that's what I meant because it's
okay, gotcha.
a high beta ETF and then it's S&P low volatility ETF. So this is basically going to tell you it's going to give you the ratio of high beta growth versus low volatility or like dividend, basically value stocks, right? Like lower beta, right? And when you see a chart like this, especially since April, this is literally showing you that the market is risk on because it's above all the moving averages. And on top of that, growth is outperforming low volatility. So money is trying to chase growth throughout this entire period. During periods of downturns, especially starting in 2025, beginning of 2025, remember guys, in February, we had an all-time high, but this ratio did not make an all-time high. All right. Mm-hmm. That was a little bit of a warning sign there. And then it just freaking fell off a cliff. Okay. That was even more of a warning sign right here. Over here, I look at this maybe like every few days because it's a good indicator of like how risk on the market is. And To be honest, we're like teetering around here, but like still, this is a massively bullish trend. All right. But, if you've noticed here is that high beta has like just, we have not made a new all time high in terms of this ratio, and high beta is just underperforming. And,
Can you pause for 1 second?
yeah,
Guys, that comment right there, more Chris, less Sam. Don't do that. Please don't do that.
it's fine.
This
I
is a,
actually saw that. I
no,
got
no, 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 no,
I
no,
was
no.
going to
This is
comment on it. Yeah.
this is a two-way thing. Me and Sam, we are always going to help each other and support each other. Don't do that. Don't try to create a divide between people. I know that sometimes it
Dude,
can get a little like, hey, I want to hear from this person. I don't want to hear from no. The
these
value that Sam
trollsters
provides.
appear all these
No,
trollsters
no, no,
appear all the time. I'm
no,
not
no, no.
worried about it at all. I'm not worried
No,
about
no,
it at
but
all.
the reason why I'm bringing it up is because me and Sam, there are a lot of blind, like what are they called? Blind spots that I have that Sam fills, and there's a lot of blind spots that he has that I tend to fill. And I think the best part about doing all of this stuff is, oh my God, this is boring or that's not boring. No, no, learn. Each one of us has something to input. Otherwise, I would not be doing stuff with Sam. Okay, so just thank you. I
I
appreciate like,
I
hey,
think
Chris is great, but trust me, Sam's got a lot more alpha this year than I have, and he's called more things right than I
yeah,
have.
but
So
I'll tell you
when this
something.
guy
When the
talks,
market's
listen.
down, when the market's down, you outperform me. That's like why we both kind of compliment each other. No, I've seen AK Willie many times before. He was just messing around. I don't
Okay,
really
good.
care about
I
it.
appreciate
And
that, and I
even if
appreciate you
it,
being here,
yeah,
AK. Yeah.
even if it was a trollster, like dude, honestly, the bigger that my account gets on Twitter, the more I start to see haters. And in this game, like if you let the haters get to you, then you already know you're just not going to make it. Like you have to get used to it because the bigger you get, that means that people's opinions start to become a little bit louder, and that like for every like 10 people who agree, for every 10 people who are nice in the world, there's always like one a-hole out there who's just there to troll. And pay attention to the 10 versus the one. But anyways, I digress. So
Yeah.
I appreciate the $5, and I really like how I guess Chris, I got to buy you something at McDonald's now because I got to buy you
That's all
some
right.
food because he sent her the $5. So I'm gonna buy Chris a cup of coffee. How about that? Just kidding around. It's gonna be reinvested, and hopefully we should actually start like a little You mentioned this a few times. We should start like a little investing account where it's like we're kind of getting both of our alphas in there.
As
Like,
long as we can
yeah,
buy some Weeble, brother. As long as we can buy some Weeble.
that's fine. Like it's what I that's like I said, like would I buy Robinhood here for like a competition investing account? Probably not. Right? Like it's what I buy Weeble, probably not either. But if you own half the portfolio, then that's fine. All right. So I think that this is going to bounce out this 20-day moving average, and I think that it's going to bounce up. And also, if you think about sentiment, like I got a bit bearish on Bitcoin, and to be honest, this Bitcoin chart looks disgusting right now, right? So if this bounces back, that's like the most bullish setup in terms of crypto. Ethereum's on the 200-day moving average, and you're already seeing a launch off of there. And as long as that stays, it's still bullish. The Qs, again, high beta divided by high growth, divided by divided by low volatility value. Obviously the Qs have not hit a new all-time high, and it's much further from the all-time high than SPY is. And you could even say the same for IWM. We need this stuff to catch up. And the one biggest indicator you can see that value is much more favorable today than growth is because the Dow Jones made a new all-time high today. Like I don't think this was really spoken today that much. The Dow Jones Industrial Average made a new all-time high today. Like this is not the time to be bearish if that's happening. Okay. Maybe this was a time to be bearish. This was a time to be bearish, if anything. This is not a time to be bearish. Like you literally have to look under the helm, especially with some of these mega cap stocks. Apple is basically at an all-time high. Amazon is basically at an all-time high. Google's at an all-time high. Meta, Zuckerberg's doing his
Can you
own
say
thing.
that again? I'm sorry. Can you say that again? I'm sorry. What was that? Was that
I don't know.
Google is out of
Wait, no,
what?
I didn't. No, I didn't say that.
Huh. Let,
No,
let
I
me,
didn't.
let me
I didn't.
just,
I didn't say that. I didn't say that. What are you talking about? I didn't say that.
Google is at an all-time high. I just wanted to
Google,
remind you,
it's
Sam.
not at an all-time high. Does that look like it's at an all-time high? It's
It's
basically at an
close.
all-time
It's
high.
close.
It,
I'm just
yesterday
I,
it had an all-time closing high.
I'm giving
Okay.
Sam shit. I'm giving Sam shit about
He
Google
is.
because
Yeah.
that is one of those winners that he should have known. He was in the trade with us, and he should have known.
Okay, just to give a little bit of background. All right. I sold Google right here. Right here. I sold Google. Okay. And I bought Meta. Actually, hold on, not there. I think it was here because Meta was like around 6. Yeah, it was like right here. Yeah, right here. I sold Google and I bought Meta. Clearly, that was not the right choice, but I was flying so high over here. I was like, dude, I am the man. I'm over here.
Sam's
Screw
like
all you
Icarus
Google
got a little.
folks. Yeah, and
Sam's
then
like
yeah,
Icarus got a little too close to
and
the
then
sun, and then Zuck came in
yeah,
and said, "Nah,
I'm the
boy."
little man. I'm the little man over here. But it's okay because we all have our wins. We're not going to be writing everything, okay?
No, but Sam,
I got to
now
give you the flowers on Google. I have to give you the flowers on Google. Like this was freaking crazy. Like I'm more
now
vigilant now. I'm more vigilant.
now is the time to look at Meta, though. So I'm saying Google is still
Yeah.
good. I love Google, but now Google is more fairly valued, where Meta is
Yeah,
undervalued.
Meta's getting interesting now. Meta's good because if we are in a bull market, guys, if we still are in a bull market, Meta will likely come back. Now, this chart's not looking good right now. All right. For me personally, I would get aggressive on Meta if it broke this 200-day moving average and came back, and the charts are look more bullish for a trade. Investing wise, like I'll nibble on Meta as it's going down. I'll nibble on them. I'm not gonna go all in, but like I'll nibble as it's going down. Anyways, Microsoft chart is like, this is okay. Netflix chart, this is okay. Nvidia chart, like this is basically at all-time highs, right? And then Tesla is basically at all-time highs. Like you can't be bearish the stock market when this happens. Okay, it's these mega caps make up the majority of the stock market. And if they're up there and not breaking down, you cannot be bearish stock market. February, this was when you should have been bearish the stock market, when the mega caps were down and the market was making all-time highs. When the mega caps were down and making all-time highs, that is when you be bearish the stock market. When DeepSeek happened, that was the warning shot. That was the warning shot, okay? And right now, that's not the case. And in fact, I would even say that we've gotten pretty oversold, okay? And if you look at like mega growth stocks that I've gotten decimated in lately, Nebius, for example, right? Like this is a terrible chart. I'm not going to sit over here and tell you that, oh man, this chart's so bullish, it's about to bottom right now. It's like this is an ugly chart when it comes to Nebius. The 20 days about to cross the 50-day and so on. So like I'm not buying Nebius aggressively, but I'm adding to it, but I'm not buying aggressively. Iron looks way better than Nebius in this case. Like it's still above the 50-day moving average. It kind of tested the 50-day moving average today. Add it here. You know, I'll add it as it keeps going down. That's fine. You know, but we're not going to get too much into the fundamentals of these companies because I already released a video earlier on it. But my point that I'm trying to make is that this is not the time to be bearish the market right now. You be bearish when you break some serious levels on the mega caps, when you break some serious levels and stay below those levels, not bounce off of them off of support, because we have not been below the 50-day. We've never closed below the 50-day moving average in the S&P 500 since May. Okay. And we have bounced aggressively off the 20-day and the 50-day. Like, just wait to be bearish. Until then, don't pull Michael Burry's. Otherwise, you're going to get liquidated, which we don't really need to touch on because that's like all over Twitter. You guys could just tweet. You guys could just search Michael Burry on Twitter. But breaking news, everyone. Michael Burry is closing it down his fund. He's closing down Scion Asset Management, and I looked at the volumes, I looked at the flows on Nvidia and Palantir earlier once he revealed his strikes, and he sold his positions in mid October. He closed his fund a few days ago. I think that maybe he had some other positions he might have been holding on to that he did not necessarily report on, or maybe he just saw everything around him and he's like, I'm not going to get back into these positions and so on, or maybe he's talking his book. I don't know. The point is that these positions, if his AUM was over $1 billion, these positions were like 2% of his portfolio. Like, how are you going to be super bearish the market with a 2% short inputs? Like I bought IWM puts, and that was 3% of my portfolio when we were testing the 50-day moving average. Like that's a hedge. That is literally a hedge. It is. You're not short the markets. You're just hedging, and I think that got blown out of proportion. In my opinion, I think that was kind of stagnating the market a little bit, along with the government shutdown, which we're clearly getting out of. Is that going to follow through? I don't know. We'll see. I'm not a fortune teller. Chris isn't a fortune teller. But we're just basing this based off of based off the signals that we're seeing. And I think for both of us, we're both in agreement that, like, look, we're in a pretty crazy setup to make all-time highs very soon and to get a Santa Claus rally. And price will tell us otherwise, because no, anyone who can tell you with certainty something's going to happen, like, run away from them. No one knows what's going to happen. No one, even the biggest market makers in the world, don't know what's going to happen, because there's other market makers in the world. No one can ever tell you with certainty where a price is going to go, but you need to make your probability bets that are going to favor on your side that it will happen, namely UNH, namely Nebius, and a bunch of other stocks, Amazon, whatever it is, right? That is the whole point of that. And right now, I think there's a much higher probability we go up and make a new all-time high than go down. All right, so except Tom Lee. Tom Lee was never bearish all the time. Yeah, go ahead.
So let's watch something real quick about how the government shutdown is gonna now that the government shutdown is over, how things might be. Like I said, I really like Gary Cohn, one of the smartest guys when it comes to like the general markets. Former Goldman Sachs guy. Really, he was in the first Trump administration. So let's hear what he has to say.
Right, we've got one leg going up.
Someone wrote it. When has that not been true? That there's the high-end consumer and the low-end consumer.
It's always been true. I just
think it worse?
I just think it's bigger and more divided today than it has been in a very long time. Between people that are doing well and have enormous amount of disposable income, and are willing to spend money no matter what's going on in the economy, and then there's those, as Becky and you were just talking about, those that literally work for the government today, who are probably standing in line potentially at food banks to be able to put food on their tables. The dichotomy between the two of those is as wide as has ever been. Now, the government going back to work will help some of that. And there's a very interesting but strange phenomena when you're a government that shuts down for 4 weeks and you don't pay your workers. The workers tend to cut back and they tend to make do over those 4 weeks. Then they get the 4 weeks of pay back, and then they go out and spend it. So it's, in a funny but true way, it ends up being stimulus for the economy. So when those workers get their 4 weeks of back pay, they'll put it into the economy, and it will feel good during those periods of times. As you point out, if you look at overall corporate earnings, they continue to be very strong. But when you look at how corporates are getting there, it's also interesting. We've seen probably more layoffs in this round of corporate earnings than we've seen in a long period of time. Over the last week and a half, 2 weeks, you've seen well over 160,000.
Yeah, why is that?
Well, I think it's a combination. But the 160,000, if you put it in relationship to the conversation you were having with Steve Leisman yesterday morning, where you were talking about, the private payroll data looks like about 15,000 jobs a week. Yeah. Well, 160,000 is 15,000. That's at least 10 weeks. We've laid out 10 weeks of people in the last few weeks.
Wow.
You go down the list, UPS is at top of the list at close to 50,000. That's purely a function of less foreign imports, and less freight. So they're telling you this has to do with trade. You're looking at Nestle. Nestle is in here at 16,000. Price of chocolate is really high, and consumers are buying less chocolate. So, the overall thought here, and we talked about this last time I was here, input prices are going up for U.S. companies. The cost of labor is not going down, and the price that they can charge the ultimate consumer is not going up. The only way to make your quarterly numbers work is to squeeze some cost out. And it feels like the cost that people are squeezing out right now is labor cost. And I said it to you guys about a month ago, and I think it's proving true in these numbers. We've seen 160, 170,000 layoffs in the quarter.
Policy question for you. Either you're Jay Powell or you're President Trump. What do you do to fix that problem?
This is a tough problem, but I do think they're working towards fixing it slowly and surely. Getting a deal done with China getting a deal done with Japan, getting a deal done with Canada, those are all very helpful. Once you figure out where the final cost of goods is, or the final input costs, and these rare earths and a bunch of these commodity inputs, which is Japan, China, Canada, once you settle the price of those input costs down, I think manufacturers have a much better idea of what they can charge and what labor they can have. And right now, we're pushing labor out of the equation. And look, there's a bit of an AI reality in there, and there's a huge AI excuse.
You know how many times stock.
Okay, so I'll stop there. I think this was very important because I think it sets the general tone of what the Trump administration is likely to do for next year. So as I was thinking about this, I was like, okay, these businesses, they're getting squeezed on margins, and they have to make sure that they protect their margins. Otherwise, their stock will get decimated, right? So what are they going to do? And the only real thing that they have control over is labor inputs. So they're looking for every excuse they have in order to lay people off, right, to protect their margins. And so a lot of times what you're seeing is the cost is not necessarily being passed through completely to consumer, but the employees are bearing the brunt of it. Now, the Trump administration is looking at this and saying to themselves, like, wait a second, like, we can't be in a position where we get to the end goal of lower inflation because people are out of work and they can't buy things, right? If you have a high unemployment, I don't care if your economy is low inflation. Like, people are out of work. It's a much worse situation to be in. So I think what we're likely to see in the next year, and this is something that's already starting to happen, is that the Trump administration is going to be pulling back a lot of that tough tariff negotiating talk and basically doing a lot of deals and unwinding a lot of these tariffs. And as they start unwinding these tariffs, a lot of these companies are going to say, well, look, now my margins are there, so I can at least comfortably maybe not hire a lot of people, but also not fire a lot of people. And that should stabilize the unemployment numbers going forward, right? So if we do get an economic boost next year from lower interest rates, and companies end up being able to finance their debt at a cheaper price, they are likely to maintain their current labor levels, and might even some companies might even boost their labor levels a little bit. So I think that the Trump administration is really trying to engineer this sort of like a nice soft landing, in that inflation comes down to a manageable level, but it's not going to be at the sacrifice of the American worker. Because if you sacrifice the American worker, I don't care if the price of eggs goes down to $1 if no one can afford to buy them because they're out of work, right? And at the same time, so many people are on government benefits right now because the labor costs are because they're on unemployment and they're all on these other benefit programs, which means that the total cost of a person is going to be more for the government. So even from a deficit standpoint, it's not good, right? And as Republicans, one of the things that they're always trying to do is make sure they're rationalizing the cost of these benefits to the people. So I think we're going to see a softening of a lot of the tariff rhetoric. And if you guys just listen to the Trump signing today, he actually mentioned, like, this literally was the biggest indicator for me. Hold on one second. Just listen to this really, really quickly, and we'll stop there. Okay. Share screen, entire screen. Sorry, I have to enable the audio part of it. There we go. Okay, here we go.
Big day, big night. It's very important what has taken place, because we've seen how good government can be and how bad government can be if people don't know what they're doing.
Well, tonight, the federal government is officially...
Come on, man. I'm trying to hear Trump, not this stupid thing.
Good. I'm glad you saw yourself.
Yeah, this thing stopped, but hold on one second. Let me put this.
Toward American taxpayers for hundreds of billions of dollars for illegal aliens and people that came before. Today, we're sending a clear message that we will never give in to extortion, because that's what it was. Americans never wanted a shutdown and voted 15 times for a clean Majority Whip Tom Emmer and
Okay, great.
These are all incredible patriots. The Airlines for America, the Allied pilots, they caused 20,000 flights to be canceled or delayed for millions and millions more Americans in need. They caused tens of thousands of federal contractors and small businesses to go unpaid, and the total effect of the damage their antics caused will take weeks and probably months to really calculate accurately, including the serious harm that they did to our economy and to people and to families. So I just want to tell the American people, you should not forget this when we come up to midterms and other things. Don't forget what they've done to our country. I also want to call for a termination to the filibuster so that this can never, in 9 months that I've been in office, I thank Walmart. They've done it for many years, but we believe in that, and we believe in that company. I want to also thank the 8 Senate Democrats who costs are way down.
Right here. This is the part. Sorry.
So with my signature, the federal government will now resume normal operations, and my administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
So right there, make America affordable again. This is the first time that he's actually said that. Okay. If you look at the things that he just said right there, he's really, really focusing on affordability now. And that is going to be the driver of this administration's policy for next year. What does affordability mean? It's going to be left up to interpretation, because, you know, affordability kind of depends on a person's income level and everything else. But the thing that, if I was a politician right now, I don't care if you can afford a MacBook Pro. So my goal is not getting the MacBook Pro prices lower. My goal is, how do I get milk on the shelf to be cheaper? How do I get eggs to be cheaper? How do I get the most basic things? Right. Well, lower inflation, but the areas of the market that I want to see the most amount of disinflation and even deflation is going to be everything that's in your face. Like, so right now, Sam, if you saw prices of gas go down to $1.50, would that be more impactful to you, or would the price of a MacBook Pro going down $50?
He wants to
Which one is
help.
going to impact you as a consumer more?
I agree with what
think you're
2 AM
muted, brother.
said. Are you sure?
I think your mic might have died.
Hold on. No,
Or
I'm
is it
not.
me? Can anyone hear
think
Sam?
it's
Can I?
you.
Or am I the
think
one that?
I think it's you. Because I could see the.
Oh, there we go. It was me. It was me. My headphones died.
I was gonna say your headphones weren't on because anyways, I think that he's trying to win the midterms. Okay. Like he wants the minority vote.
Bro,
And
you have to win the midterms,
Yeah.
because otherwise you're gonna be the.
he wants to win the midterms. He wants a minority vote, and I think he knows that now. So he knows, hey, this K-shaped economy thing is not going to work right now.
Yeah.
I need to make some money for the lower class, and that's why he's talking about the $2,000 tariff stimulus check. That's why he's talking about all this other stuff. He knows that $2,000 stimulus check is not going to be good in the long term, because it's literally printing money, but from the government side. Maybe he's looking to not print money and possibly get money from the tariffs, but that's going to go against what he's talking about paying down the debt and growing ourselves out of debt. Because if he takes in more debt from the government, he's essentially printing money from the government side, which the Fed is going to have to be forced to buy that debt as soon as you start QE, likely in the next meeting. But no one's thinking that far. The economics and inflation rates won't catch up that quickly until after the midterm elections, which at that point, he's not going to be so concerned about inflation anymore, at least from what I think about it. But by that point, we're going to have a new Fed chair. We're probably going to have all this crazy crypto and monetary stuff happening. Like, once a new chair gets in, I don't think it's really about printing money anymore, because I think they're going to figure out a way where they can just print infinite amount of money and not impact inflation by doing helicopter money in certain parts of the sectors and in certain regions of the country or whatever. I don't know. Modern monetary theory, whatever it is. But
The thing is,
yeah.
this is where you really do need, and I hate to say the word wealth redistribution, because the thing is, you don't want to have a situation where 5% of the population owns everything, and then the 95 other percent of the economy is basically struggling to get by. In a totalitarian system that works, right? Because the thing is, like, people don't have a choice. In a democracy, that doesn't work, because now what that does is invite that other 95% to vote against the 5% and the interests of those 5%. So the thing is, the more you get disparity between the rich and the poor, democracy has a way of correcting for that, right? And that's through voting, right? So in my opinion right now, the Trump administration, like I said, they need to make sure that they don't get absolutely destroyed in the midterms. And the way that you do it is by getting people to stop complaining about inflation. Like I said, you don't need the entire economy to deflate in order to get there. You just need those things that are just in your face, dude. Like, if you're able to get those parts of the spend of the consumption that are in your face down, you make people feel good. Like, dude, I would like to go to the grocery store or or like my local Kroger and not tell my wife, babe, put down the organic bananas. Let's get the regular ones. We don't have it in the budget. You know what I mean? I mean, I don't do that, but I mean, sometimes I do. I'm not gonna lie, I'm a cheap ass dude. But
You're a cheap ass mofo. You know you
I am.
do.
I am.
Yeah,
I'll tell them.
I do that too. Like, I'm just like, man, do I need the large fries or can I just get away with the meat? Like, I always like it. Just I don't need to. And in the long scheme of things, it's not really a big deal. But like, no,
Yeah.
I see what you're saying. Like, we were both kind of raised in like the frugal mentality.
Yeah.
But yeah, no, I mean, I don't want to have to worry about that either. The unfortunate part is that a lot of people can't even get bananas,
Yeah.
right? They can't even get certain things because they just can't afford it. Meanwhile, Joe Schmoes in the stock market are thinking about like what degenerate call options to buy before the market closes, basically blowing somebody's entire week of grocery bills in a matter of a couple of minutes. Like, it's not, well, you know what? I'll take it back. Some of those degenerates actually can't afford bananas, but they just do it anyway. But, I mean,
the key areas I think that they're really going to focus on are like the three main areas that I think that are really in your face when it comes to a consumer. The first thing is food inflation. You want to try to control the price of food, right? If you get inflation, like, food is one of those things that it's a daily reminder of how poor you are. You know what I mean? You walk into the store and you're like, holy shit, I can't afford bananas. That's going to weigh on your brain, right? Same thing with your kid. If your kid
think
is
about
trying
the
to eat
eggs, man. Think about when those
eggs,
eggs are
food, I mean,
super expensive, man.
right.
That was an insane time.
Right. And it was in your face. And I honestly believe the price of eggs might have actually got a couple of points lower for the for the Kamala Harris election, because people were like, oh my God, the egg prices. And then it's funny because if you remember the first 4 months of the Trump administration, eggs were still high, and the Democrats were just harping on that every day. Like, oh, you said the price of eggs is going to come down within 2 weeks of him getting elected. Like, bro, that's not how it works, first of all, right? But now, do you see a single commentator talk about egg prices anymore now that they're lower again?
Dude,
No.
it's
It's all politics. It's all politics.
I'm not a Republican and Democrat.
Yeah.
I just want the stock market to go up, and
Yeah.
that just so happens to be whoever's in office that's going to make that the case. We're at all-time highs.
Yeah. So
It is both of these people's fault. All right, I'm sorry. Like, I hate it when it's like
the
it was
blame game.
Biden's fault, and when Biden's in it, it was Trump's fault, and then like the government shutdown is the Democrats' fault. But let's be completely honest, the Republicans are letting it happen too. You know, it's like it's just whatever. Anyways,
So
no, I see what you're saying. I
food
see
is
what you're saying.
one. Food is one. Number two is electricity, and number three is shelter. Because the thing is, the monthly bill on electricity comes every month. So it's once again another reminder of how much worse you have it today than you did last year, right? Inflation on shelter is another thing. Like, it's a constant reminder every month when you're paying your rent bill, and the landlord comes and says, hey, I got to raise the rent 20% because my costs went up, all that BS. That's another problem. So if you can control those three things, number one, control shelter, control food, and control utilities, I think the rest kind of fix it themselves. So if I was a Trump administration official, those are the three things I would work on: getting home prices and rental prices of apartments lower using whatever government policies that I can implement in a very short period of time. Two, getting inflation on food down as much as I can, because that is, once again, a daily reminder. And then electricity, which I think is something we have to watch out for. And the reason why we have to watch out for it is because these data center build outs are, and this is because this is your expertise, you can add some commentary to it. I think that we're hitting some walls in some parts of the country right now where people are pushing back against data centers now. So the existing data centers, the value could be actually going up, because if you're trying to build out a new data center, you've got all the GPUs, you've got all the chips, everything. But at the same time, you can't find a location because everywhere they're telling you, hey, I want to build a data center here. Go fuck yourself. No, I don't want my
Guess what?
electricity prices going up
Guess what?
50%.
The
Yeah.
hyperscalers usually build data centers in metropolitan areas, and
Yeah.
that's where power supply is not is very. I want to say scarce, but it's very high in demand. Obviously, because you're in a metropolitan area, and that's the reason why you have the Nebulouses, you have the Irons, the Ciphers, and all these other places build it in Arkansas, in Texas, like in the middle of nowhere. Why? Because the data center demand is much more in supply in those areas, in addition to buying more utility companies building more supply out there for as far as energy goes. And that's the reason why you have the Nebulouses and Equinixes and CoreWeaves building data centers outside of the US, one to serve a different region, but also because there's much more real estate to build it for, and there's much more available power. This is probably the one thing that I think China is probably going to, I don't want to say outpace us, but catch up on in some sense, because their energy and electricity is very cheap compared to us, and they have a ginormous amount of real estate to build their data centers in because the population is so condensed in certain areas. They're not going to win the AI race, in my opinion, not even close. But there is a bit of a catch-up play there. I'm not going to get into that one, but that is my opinion when it comes to the energy note that I forget the name of the company that the firm that released that data earlier today. But I would really attribute that to FUD. I
Now,
don't necessarily think it's going to be a profound issue, and if it does, I don't think it's because like some firm saw it happening, because there's like a million things that we hear could potentially be an issue, and it never becomes an issue. But then the one that actually becomes an issue is like, oh wow, they forecasted this a long time. Yeah, because they're throwing darts at the wall and they're finally going to hit something, right? Of course they're going to hit something if that's the case. The way that I see it is that this is the reason why they're paying these companies to build these data centers. It's because they can do it very quickly, or they have the capacity already available, and also the fact that they already have these tight relationships with utilities companies that are local in that area. Like I said, namely Texas. Okay, Iron's building 2 gigawatts in Texas. Cypher's building another gigawatt in Texas, which they just announced their earnings recently. There's a lot of companies building data centers in Texas. Elon Musk is building Star City in Texas. Like, why? There's a reason why they're going to Texas, is because the region is obviously much more favorable in terms of land and real estate, contracting work, but also the grid is much more available in Texas than anything. This is why they're not building it. Like, it's like, well, then why not just build it next to Silicon Valley? It's because, dude, like Silicon Valley is probably the worst place you could build a data center because you're going to shut the whole city down.
what's funny is I'm glad you mentioned that. Did you see the news article about 2 data centers in California where the equipment is just sitting idle right now because they can't get the hookup right now?
No, I
Do you know
didn't
what
see
I'm
that
talking
one.
about? Type in Google, just be like AI data centers on hold in California. 2 AI data centers that are just basically like languishing right now. The one thing that I will say, as I was doing my research, is I know that the useful life of a lot of these older GPUs, like people were saying, like, hey, they're still utilizing them. The challenge that you run into is if electricity like uptake is a problem and you're hitting the wall, because the efficiencies on those are not as good, what you're going to do is transition more towards Blackwells, right? Because they have, on a per efficiency basis, like dollar cost basis, it's cheaper to run a Blackwell, and you get this huge boost in on a per dollar amount, and your margins are stacked. So that might end up being a big problem for something like CoreWeave. I'm just putting it out there. Like, here's an example. Let's say you have a 5-year-old GPU, right? You're renting it right now for $1 an hour or $1.50 an hour. And the electricity prices is costing you 65 cents to run that GPU. What is the profit margin on that thing? It's not that good. Versus a Blackwell, you're getting $7, $8 per hour to run the same exact thing, and the electricity that you're using is the same amount. So you see that margin difference between the two. So if you're a data center, you're thinking to yourself, I am not going to keep my data center full of these old chips. I'm going to retire them faster, and I'm going to put in more Blackwells. And believe it or not, that might actually mean more demand for Blackwells going forward, with a lot of these other older GPUs coming off at a quicker pace. That's something that I'm trying to keep my eye on to figure out, like, okay, what is going to happen? And there actually could be a business idea where you can build out a data center in a super low energy area, like, let's say, Iceland, and ship all of these old depreciated GPUs there, and the cost of electricity there is super cheap. Build them there.
Yeah.
But I'm telling you, if you're in California right now and you're thinking that, hey, you can make a margin using those old GPUs, dude, those margins are barely, in my opinion, like 5 to 10%. Versus a Blackwell, you're going to get way better margins.
I mean, like I mentioned, they're building a lot of them in remote areas, and they're manufacturing the chips in Arizona, which is very demanding in power as well. There's a reason why they're strategically picking these places. They're not going to do it in New York City and LA or Silicon Valley. They're going to do it outside of it. But yeah, no, I mean, this guy's right. At the end of the day, it's all bullish NVIDIA. And guess what? The day that it's not bullish NVIDIA, guys, is the top of the market.
Well, no,
NVIDIA is a $5 trillion plus company. They're not. When NVIDIA goes down, the market will go down. That is like going to be I'm like 95% confident that's going to be the case. With
the reason why I'm bringing it up is not because you want to be against NVIDIA. You want to be against all of the hyperscalers, neoclouds that are sitting on a stack of old bullshit chips that are going to be obsolete in a very short period.
We're not going to get into that. We're not getting into that.
And here's the thing. Some of them are fucking fugazi, okay? So they're not going to be able to make money. They're not going to do well. So that's where we have to look as investors to say, you know what? If there is going to be an AI bubble pop, it's not going to be NVIDIA that takes the brunt of the downward move.
Oh, no, it's going to be these stocks. Yeah, no, of course.
It's going to be the data centers that have all of these old GPUs, and now they can't do anything profitably. So,
but I don't think that's going to happen. Not for a long time, in my opinion. Okay. I don't think.
Well, here's the real question. Here's the real question. Which of the data centers plays do you think is fugazi that you would not put your money
I
on?
think it's too early to tell. Because some of them, like Clean Spark, for example, which is still attached and correlated with the price of Bitcoin, which we've seen. And I have a small position in Clean Spark, and honestly, I didn't even realize it was down because that's how small it is. But the thing is that they're announcing plans to switch into HPC. They've raised capital, and then they bought land, but they haven't even they haven't even released plans of when the data center is going to be built. And I'll tell you something, those are the companies that are going to be the first to go if this all doesn't work out. Now, I'm not saying that they're not going to work out, otherwise I wouldn't have invested in the first place. I'm just saying that those type of companies are probably the ones that are not going to work out. The ones that are say they're going to do, the ones that already raised the capital, and the ones that are like very far behind in doing it, and the story ends, right? CoreWeave, I don't think CoreWeave is going to be a loser in this scenario. I actually think CoreWeave is going to be successful in this. I think there's short-term headwinds when it comes to CoreWeave, because what people need to remember from the earnings call, and maybe that people don't remember it because people just like look at CoreWeave that's down like the most out of all of them, or leading the way down, and they think that that's the worst one of all of them, when that's in fact not the case, because CoreWeave is the go-to for neoclouds when it comes to Microsoft, OpenAI, and Meta and other companies, okay? That's how it is right now. They have that compute readily available today. CoreWeave had an issue as far as delays of building out its data center and bringing it online because it needed PowerShells that were provided by Core Scientific, Core Scientific was the one causing the issue, not CoreWeave. However, it is CoreWeave's fault because they decided to go to Core Scientific. And the question that Jim was asking the CEO of CoreWeave was like, I mean, I would be pissed if I was Jim too, because he probably has a lot of money in CoreWeave, but also has a lot of investors that followed him. So it was like, well, then why did you go with Core Scientific in the first place? You had all of these choices, you had all these companies to go with. Why'd you go with Core Scientific? And the CEO of CoreWeave just did not have an answer. I'm sorry, but your stock's going to sell if that's the image you're presenting to your shareholders. And that's one of the reasons why it sold. And it wasn't just because of what Core Scientific was. It was just that he didn't step in front of it and he had no answer on how to resolve this other than like, we're going to be fine. And you know what? The market's like, he's like, trust me, bro. And the market's like, no, we don't trust you. And they sold that shit off. The problem was that everyone looked at that and was like, well, if CoreWeave has a delay problem, that means Nebius is going to have a problem. That means Iron's going to have a problem. That means Cypher's going to have a problem. That means Applied Digital's going to have a problem. That means Bitcoin. That is ultimately what has caused a massive induced sell-off of that entire sector. But it also doesn't help that growth is underperforming value right now. That certainly doesn't help. But like going back to your point, if we get a pullback, okay, these data center stocks are going to be cut in half. In fact, some of them were already cut in half. Okay, like some of them already were. Like, look, guys, this is a very high beta space. And if you can't stomach this volatility, do not invest in this company or your position's too big. As simple as that. As simple as that. If you can't stomach it, you should not invest in these companies.
Here's a question. Are any of them profitable?
Okay, so now it depends on which one you're talking about. Iron was not profitable last quarter because they had a big write down. But as far as a Bitcoin mining business, which is supporting most of their net, actually, I would say like 97% of their income and revenue is coming from the Bitcoin mining space, which they're very successful at. That is what makes them profitable. My argument and my rebuttal is that, look, you're not buying these companies based on their trailing 12 months earnings or based on the trailing 12 months operating income. You're buying it based on the ARR guide and the fact that it's going to continue propelling at triple digit revenue growth, in addition to providing adjusted EBITDA margins that are very high for these companies in the future, right? Like anyone who's looking at Iron, and I pointed it out. Okay. I pointed it out on Twitter. Actually, I'll pull up the tweet right now. Hey, go like dance for everyone right now, because I hate like doing this like when it's dead right now, because it's like I feel like I'm pressured to find this like right now, and
go for it. No,
sometimes I suck at working under pressure.
The reason why I bring this up is because, you know, there has to be, eventually you have to get to a level of profitability, and the question is, how do you get to that profitability, especially with the depreciation comment that Burry made. You know, if there is a way to project out what the profitability is going to be in a couple of years, then you could make a judgment call on, okay, what should the valuation be, right? Is this going to get the same valuation as something like a Microsoft, an Amazon, a Google? Because the thing is, for me, when I look at this, I'm like, okay, if Microsoft could build out these things and generate a profit that's similar to them, right? Why wouldn't they just buy these companies instead of doing deals with them? So as an example, if NVIDIA really thought that, hey, you know what, I think that there's a way that this is going to be a really big deal. I mean, NVIDIA's got the cash. Why not just buy CoreWeave out completely? Why would you want to invest in CoreWeave versus just buy them out, right? Same thing with Google and all of these guys. In my opinion, this is very similar to commercial real estate, in that these businesses would rather have the financial flexibility to take on the risk of that commercial property going into depreciation, not really generating too big of a cash flow for them that they can exit at any time. So here's an example. If I'm Google, I want to open an office in Atlanta. I could go out there and buy a building, and basically now I'm spending all this money. It's sitting there and it's generating, I'm not paying rent, quote unquote. I'm saving money on rent. But at the same time, the building itself is depreciating, right? And whatever savings I have in rent, I'm not reinvesting back into the business. And that money that's locked away into that building is not something that's being constantly churned back. So when I look at that, I'm asking myself, like, okay, why do these hyperscalers like Google and Microsoft and Amazon, why are they doing these deals for compute while they're also building out their own thing? And this is where, like I said, I'm always like skeptical in trying to understand, like, what is the eventual margin that we're going to see in a lot of these hyperscale, like these neo clouds. So I think the best one, in my opinion, is probably going to be Nebius, in that their business is not completely reliant on just renting out compute, that they actually have other lines of business that can kind of support their whole thing. And they're very efficient. They've been running, this organization well past their IPO. Whereas a lot of these other guys are, let's just say, they're just going from one business model
Well,
to
not necessarily. Iron's been doing it for about 7 years.
no, but they were a Bitcoin miner that
Yeah,
now are going
they're a successful Bitcoin mining company, but also
right.
management that's running Iron is definitely no stranger to the energy business, which they have a lot of experience on in Australia. But they've also worked in Wall Street and have a finance background, so they understand the mechanics of like a lot of these businesses. I'm not saying like they're going to like 100% be successful, because I'll tell you right now. Well, actually, I think they're going to be 100% successful. I don't want to say that, but I think that's why my money's in it. But I brought this up because Couch Investor commented on it, and I added some light on it, kind of explained it a little bit. So on their last earnings, they were net profitable. And I did know, it was funny because I noticed this on the when I was streaming the earnings. I was like, oh, okay, cool. So look, they're actually more profitable than the last quarter. And I was like, wait a minute, hold on a second. This doesn't make any sense. And I saw this and I was like, okay, I'll look at that later on. And I didn't get to make the announcement on it. And then when I read Couch Investors tweet about it, I was like, all right, let me put some light to this, because he realized it too. And he's an Iron investor too, but like, we want to provide information to you guys, and not to say that we're being bearish, but it's like, it is good to be financial literate. Okay. I'm not an accountant. I don't have a series 6, 7, I don't know, whatever, but I know enough to understand like what's kind of happening here. And the thesis at the end of the day, before I go over this, is that in the next 12 to 6 months, they are going to have, because I'm thinking Nebius was $7 to $9 billion. Oh, they're going to have $3.9 billion ARR in fiscal year 2026, 2026. And yeah, I mean, I didn't come into this earnings super bullish. And it's not like I was like, oh, well, they're not going to actually be net income profitable next quarter, because I had no idea that was going to happen. What I didn't know was the chart. And the chart looked like to me that the market was getting a bit ahead of itself for earnings. I didn't think they're going to have like a 30% pop after earnings, because it was already up like 8 times. And they already reported their amazing news before the earnings about the Microsoft deal. And well, I mean, when you report news like that before the earnings, what else could you possibly report on the earnings day other than just whatever is going to lay out the foundation of whatever everyone already knew? They did, of course, come up with the $3.9 billion AR, which was very good news. I think they came out with this 85% just EBITDA, but the stock got sold off anyway. It was not, I didn't think it was going to get sold off, to be honest. I just didn't think it was going to be up 30%. But it really didn't help. The stock market was down the next day. That didn't help. And same with Nebius too. But the expectations were very sky high the night before the earnings. And I remember, hey, $80 the night before. And it was like, that's a little crazy to be running that hot into. Anyways. The issue was that they had a $665 million unrealized gain on financial instruments. And then when they wrote that off, basically they were able to become profitable. Does it matter? It doesn't matter to me. I don't want to say I don't care about it. It's good to know, but it does not change its thesis. The thesis is the build out in 2026 and almost $4 billion ARR by 2026. So that's an annualized run rate, guys. That is not going to be projected revenue for 2026. That means that the very last quarter that they're going to report, and Nebius does it by month, the very last quarter that Iron's going to report in 2026, you're basically going to multiply that times 4, or I don't know how they do it. I got to look into that again. Let's just say, for example, the very last month, they report about, I'm trying to do the numbers in my head real quick. 4 times 12, I believe, is 48. So they're going to report about like $350 million in the last quarter. That would bring an annualized run rate, because you multiply it by 12, of about $4 billion, and that would meet what they're expecting. I think they're going to exceed those expectations, and I think they're actually going to finish what Dan Roberts mentioned on the earnings call, was that they're going to meet the deadline, because they always have, and that they might even be ahead of time. And on top of that, we have not accounted contracts for the remaining 2 gigawatts capacity. So Microsoft is 200 megawatts capacity. They've already counted for whatever's available right now. Hey, there's going to be more deals on the table. Why would they build out 2 gigawatts capacity if there's no deals on the table? So I'm bullish in Iran for that reason. But to go back to answer your question, are they profitable right now? On paper, on a GAAP basis, they are profitable. Under the hood, they are not profitable right now. But only $7 million came from AI cloud. Okay. The rest came from Bitcoin mining. The AI cloud is going to grow astronomically in 2026. In fact, for Nebius, they said by the end of the quarter of Q4, Meta will already have most of its capacity fulfilled, which means that Meta is going to pay a huge part of their $3 billion bill, at least part of it, by next quarter. Nebius is already making money off AI cloud. They have been for some time. They already had capacity around the entire world. They've already been building data centers around the entire world. They already own co-locations and full stack data centers around the entire world. They already have a lot of compute available, which is going to be going to Meta for the $3 billion. This is why I was bullish Nebius before I looked at these other companies. This is one of the reasons why Nebius was up 4 times. The reason why Iran is up about 10 times is because, one, no one knew about it, right? Other than if you're listening to Mike Alfred or a few other people, maybe Couch Investor was early on it too. Or you're looking where you're supposed to look. And that was my oversight. And I'm keeping an eye out for these things. The thing is that everyone's looking out for it now. So it's very hard to find these things now, right? So,
my commentary on this is pretty much that looking at the business model of this business, I think in the short to medium term, I think that they are going to do well. I do think that at some point, if there is any sort of indication that there's a pullback on demand for compute, or at least some rationalization on compute going forward, that this is going to have a very similar downward move that commercial real estate is going in right now, where commercial real estate for the longest time has been a really good investment because there's always this constant demand. You needed it, and then COVID happened, and all of a sudden commercial real estate is like not necessary, not the greatest investment. And it's kind of the same thing when it comes to these guys. The difference between commercial real estate is that commercial real estate is more long-lived assets versus these guys that have this giant pool of depreciating assets that, yes, the depreciating asset argument that's being made right now that, oh, this is going to be like a 4-year, 5-year time horizon on depreciation. I think that's a major risk that I don't necessarily know if the market is 100% pricing in, because like I said, right now, any sort of like notion that the amount of build out is too much, or there's not enough, not enough, but there's not enough demand for the AI services that are underlying these businesses. And you're going to see a repricing of these businesses much faster than anywhere else. So I would say, yes, you can invest in this business, go right ahead. The only thing is just be cautious in that even a slight shift in sentiment could theoretically crash this market very hard, very quickly. Because like I said, just think of it from a business model standpoint, saying, look, the hyperscalers are right now, there's literally 4 or 5 companies that are buying up all of this capacity on a forward basis. But just like commercial real estate, and I've seen this before, there's a couple of towers in New York City and a couple of towers around the country where, you know, these guys, the what do you call it? Like the Googles, the Microsoft, and the Amazons, they thought that they were going to need office space, and they just said, nope, you know what? We're terminating our lease 5 years early. Here's your breakup fee, and they disappeared. And now all of a sudden, the what is it called? The commercial landlord is just sitting there saying, holy shit, I'm sitting on all this commercial real estate that that no one wants to occupy, even if they lower the price down significantly. The problem is, when it comes to this stuff, there's only a few set of pools of buyers that they could sell capacity to. So I don't know. Like I said, I'm not saying that this is a bad investment, not saying that at all, but just be very cautious in that if there is any sort of pullback in demand for the services, that that the hyperscalers can honestly bail on this whole thing very quickly. And that's something that even Zuckerberg mentioned in his earnings, right? So he basically said, yes, we're building out all of these data centers and everything else, but if at some point they realize that they've overbuilt, they do not mind pulling back and stopping. And I think that is something that we have to just be cautious of.
Yeah, I agree with you. That will happen at some point, but that's not right now. Like, that's the only thing, is that like that will happen at some point. My projection, and this is the reason why I'm invested in full stack companies, is because they offer an AI cloud. Nebius said on the call that, look, we're building out these data centers very quickly right now, but the goal is cloud. Okay. The goal is to offer the software on top of their bare metal, not build out data centers for hyperscalers, because that is much higher margin, because think scalability. That's a lot higher margin because you only have to build out so much. The operation of it gets cheaper the more that you operate with the same amount of software. Iron's doing the same thing, and that's what he talked about on the conference call as well. Okay, like that's the goal with these companies. I don't think that people can be building data centers until infinity. You're going to run out of space. Demand is still going to get there, but like not at this scale this quickly, right? That's the goal of the cloud, to build out the capacity so it's available, so you can sign up these small clients across 2 gigawatts of capacity or more, because Nebius is 2.5 gigawatts, Iron is 2.91 gigawatts, and it's probably more than that later on, and lease out the compute via software, so that way when one company turns off their stuff, you could turn it on for another company. This is exactly what AWS does. This is what Microsoft does, Google, and so on. These are hyperscalers in the making, guys. That's why I'm invested. I'm not invested in it because, look, they're going to build all these data centers. No, I'm invested in it because these one day will be hyperscalers. The hyperscalers today will be like massive, crazy hyperscalers. But
here's a question.
Yeah, go ahead.
Why? So with all of this build out that's happening, and even the news hasn't stopped around how many companies are going to build out their data. How come SMCI has been languishing, especially since their order book for next year?
SMCI is like that because of it just lowered its guidance. Like it literally, they just had their earnings like 2 weeks ago, and they lowered their guidance, and they're getting demolished by Dell. Okay, like right, like Dell is winning right now.
But they lowered their guidance for the short term, not the long term, right?
Yeah, and the market hates that. And it doesn't help that growth has been underperforming everything. Dude, if we get new all-time highs, SMCI is going to be back at $45-50. Like, come on, man. The market's going to forget about this garbage and nonsense soon. I mean, well, the only thing is that the spreads expire in June, and we don't know if we have enough time for that. But
yeah, it is a little short. So I have to, like I said, I'm cautiously optimistic about SMCI. I still think that if they do report some good numbers in the first quarter, that we could see a nice bounce. But I'm starting to lose a little bit of faith in SMCI, only because they seem like they're really good at promising things, but at the same time, when it comes to delivery, they've always had this, like, I don't know. And it's funny because you see the products everywhere. So you're like, this doesn't make sense. You're starting to see, every time you see these data centers, there's like, they're loaded up to the boat with all this SMCI gear. Like, I barely see a lot of Dell stuff, but apparently Della's winning the
Well,
race. And I'm
dude,
like,
I'll tell you what it was. The market thought the same way, and they saw the guy down, and they were just like, "Nope, I don't want it anymore." But at the same time, like, dude, the pullback we've seen lately, it might continue, right? I don't think it's going to continue. I think we're going to bounce back, go to all-time highs. And when growth comes back, these stocks are going to come back. They're going to come back like they always do. And the day that they don't is the day when I start hedging. I start hedging when it doesn't happen. I'm not going to tell you that it's going to definitely go up. I think it's going to go up. I think the probability is high it's going to go up. But look, if these suckers break down, I'm going to start to throw on some hedges to minimize the downfall. And until then, I mean, this is like the SMCI was like always. It was always a trade. I don't think you thought it
no,
was.
I agree with you. SMCI is definitely just a trade for me. But at the same time, when I look at it, I'm always asking myself, like, what the hell is going on here? Like, the numbers look pretty good from like next year perspective, and then you're starting to see, like I said, it's like almost like you're getting all of this premium in the build out of the data centers. But then, like, when it comes to the core components of the data centers, it's like, why aren't you given the same kind of?
Let me tell you something, dude. Micron was always a cheap company, but it always got the brunt end of the force because of the fact that no one was thinking about components and chips when it comes from memory perspective on how important it's going to be when Blackwell ramps up. All right. Micron has been trading cheap. Now this sucker is starting to get expensive.
Yeah.
Why? Because the market didn't realize it. And when the market realizes something, they bid it up to no end. And this is, I'm a growth stock tech investor. Like, this is what happens, right? Like, you're talking about Webull and stuff. It's like, yeah, Webull's probably going to have their moment, or I don't know, my opinion, I think they already had their moment. But when the market wakes up and decides this is actually a good idea, then it just runs and takes off. It's like AMD. Like, the market was making all-time highs, and AMD was like in the mid hundreds. And to a lot of people, Google, it made no sense. Okay. Hannah, though, I don't think SMCI is going to be a Google or AMD. I don't think it's going to pull that crazy stunt move. But you already, like, when a market hits a stock, it doesn't matter. It doesn't matter what they come up with. PayPal had actually a good quarter last quarter. The thing was at $80 and just got sold right off the very next day. It's like, it doesn't like it. The market just hates the company. And that's just, at the end of the day,
sentiment
doesn't matter. Yeah, it doesn't matter how we feel. It's just whatever the market says. It's just whatever the market says. And you know what? We could wake up in a couple months and the market just hate data center stocks, and part of my portfolio is going to get decimated, or at least continue to get decimated.
Western Digital, that's another one that's been on a tear, right?
Yeah, Western Digital and SanDisk. These are more attributed to memory companies. Similar, you look at PSTG, Pure Storage, Dynamic Memory, and I forget the other term as well. Like, these are obviously important components in servers, and they've been lagging for a long time. And it's like the market's like, hey, this is important. Let's jump into these stocks. And the next thing you know, SanDisk does like a 4 times in like a matter of a few days because like everyone's surprised about it. So I mean, we'll see. We'll see. I mean, GE Vernova, same thing, right? That thing's been sitting like a freaking dead mouse for a long time at bases and just goes takes off. Dude, Grab's gonna have its moment. Grab is gonna have its moment. And you're gonna get all these mofos chasing it, and then the thing's gonna run. And when it starts running, when it starts getting the top, I'm gonna be like, yeah, I'm gonna get out of my leaps now. I'm gonna get out of these leaps because everyone's jumping on ship now, and that is my exit. That is my exit. Not completely. I also hold on to shares, but like the options you have to be strategic with.
It seems like people are forgetting that, like, semiconductors in general are a cyclical business. Like, I feel like that's the thing that the market is getting, I wouldn't say wrong, but basically everyone thinks that they've got the next NVIDIA in their portfolio. And that's why you're seeing companies like Western Digital go from, like, literally in April, $30 to now $166. And the valuations are based on this forward growth curve that just seems to, like, quote unquote, never end. But then, like, it's almost like the law of big numbers don't apply anymore. And it's like, yeah, that's not how things work, but whatever. I mean, if we're in the midst, and this is literally where you have to kind of borrow a little bit of George Soros. You know, the 3 times where you can make money on these things is when there's a bubble, you make money on the ride, and then you make money on
This
the
is the
fall.
time. This is
Yeah.
the time when things just run. Like this is
Yeah.
the time when when the coast is clear, you press the gas. When the coast gets crazy, then you bail on like high leverage options and you throw on hedges and so on. Like this is just what I don't know. This is the playbook that I go by, and I got my positions that I have for a while, and I got my stuff where it's like, look, guys, if bombs start falling, I'm vacating these positions. Like I am not going to be a bag holder in certain companies. Like I refuse.
So you're ready to bail. Like you're like, I'm
I never
waiting.
said I'm not going to bail on I'm not going to bail on Nebius. I'm not going to bail on Iron. Got a little bit scared last Friday, but I'm not going to bail on these things. And there are companies where I'm going to bail on. And
Do you think that there's a possibility that Nebius goes down 70-80% back to the 20s? Is that even a remote possibility for you?
I can't tell you because I don't know how the market's going to be. Right? Can it? If we stay in a bull market, I don't think that's going to happen. I don't think as long as Nvidia is near all-time highs, or as long as the markets stay bullish, I don't think Nebius is ever going to go to $20 or $30 range. But if we have a catastrophic bear market and China's leading the AI race, and the Oracle collapses because of all its debt that it came up, and like OpenAI, like Sam Altman goes to jail and all this crazy stuff. It's like, yeah, Nebius is going to $10, guys. I'm sorry, Nebius is going to $10.
Wait, why is Sam Altman going to jail?
I don't know. I'm giving like the worst case scenario where I could see like all these stocks fall like 80%. Like
gotcha.
when that whole thing is done, yeah, I'm gonna hedge like a mofo when that happens. Like when that,
you know that like you have to start hedging before the fall.
no, you don't. No, you don't.
Falling, right?
No, you don't.
No?
You need to start hedging when you start breaking the moving averages. This is a thing that Stock Talk has always talked about, and also Logical has talked about too. And kudos to those guys because they really opened my eyes. And I mean, I've done in Discord where I'm like, I throw on hedges, and like sometimes it works, sometimes it doesn't. Like that's cool because the rest of the portfolio is running. I don't really care, right? And the reason why is because like, why would I hedge right now when like, and I that's just why I look at the charts and stuff, is because like, why hedge right now? Like you're going to pull a Michael Burry if you always think that it's time to hedge. Right. But like I kind of understood why he would hedge. I don't know why he hedged so early, but like around beginning of October when you had that liquidation, like it was kind of a scary moment, right? Because if Trump didn't flip the script after the market closed that Friday, we would have had probably a massive correction by now if he still was fighting with China, right? Like if his advisors didn't say to him like, dude, you need to chill on this tweeting right now, like we would have been in a massive correction. But Trump saved the day, as he always does.
You know what's interesting? Everyone that I speak to about like this whole AI narrative, they all tell me one thing: it's a bubble, but I know when I get out. And I was like,
yeah,
how are you gonna know? And they're just like, no, I'll know. And I was like, huh, interesting.
I guarantee you half those people are gonna try to say they're gonna get out like when we're near the bottom. Look at all these freaking like analysts and shit. Look at what's a company
I'm
that
telling you, it's like this is
yeah,
like the largest game of musical chairs that's being played right now. You know, it's like everyone's like, I'm long AI, but I know that eventually AI is going to come down. I just don't know where it is. But no one is, and this is the part that I think that always gets me, when there's so much euphoria to the point where they think that they're like, do you think you're going to be disciplined enough to get out and not be like, oh my God, this is sold off 20% now?
I'm going to wait for the price to tell me. Like, why do I have to predict that right now? I'm going to wait. Look at it this way. I'll tell you right now, there is no euphoria in the markets right now. In fact, I would say it's a complete opposite. I'd say everyone's worried right now. Okay. Like, even I'm worried. Even I'm like, holy crap, we're in a 20-day, 50-day moving average. Like, even I'm worried, but like, I'm not going to liquidate my portfolio because
No,
that's
no,
ridiculous, right?
the reason why
It'll bottom when I do.
the reason why I'm asking is because right now, let's say Nebius is down 30%, you know, in literally like
They're more than that. They're down more than 30%.
they're down, right? The question is, at what point do you say, holy shit, that was the top, and now we're on a secular decline?
I don't think, and I admit I made a mistake by trimming some stuff on Friday, which I shouldn't have, like, because I was looking at the 50-day moving average and I got worried, right? But the real move is to hedge when that happens, not like trim some positions, and it wasn't a lot of it, but
No, I'm just saying,
when is it time to sell Nebius? I don't know.
no,
It
but
totally
this is
changes.
what I'm trying to get at, is that you knew that earnings was coming up. You're like, okay, yeah, this is coming. The time to hedge is not before. I mean, after it's down 30%, it's hedge before it goes down 30%.
Well, I'll tell you something. I wouldn't buy puts in Nebius if that happened. I buy puts in like the worst piece of shit in the stock market.
Yeah, that makes sense.
Like I wouldn't buy puts on. I'll probably. I don't think Corey for the premiums are too high, and that's not even a piece of shit anyway. Like I don't want to say what I'd buy puts on because I don't want like people. I don't want to like give this connotation that I'm bearish or anything because like we're in a bull market and it's just so hard to be bearish right now. It's like buying puts in Palantir is probably the most ridiculous thing that anyone could possibly do in terms of long-term puts. Like I don't know. Sometimes like I think to myself like, why would Michael Burry do that? You know, like why would he do that? It doesn't make sense why he would do that. But he shut down his firm, so maybe that explains the reason why. But
well, the thing is, if you think about it, it's not a bad idea to buy calls and buy puts at the same time, because if you think that there's going to be, let's say, a really strong upward move, whatever you paid for those puts is going to be like whatever, right? And at the same time, if you think that the market could crash at any time, whatever, those puts are there and the call options will be weak. So the question is,
well, that's not
why
true.
why not be long on both sides, right? Where you're basically, because the thing is, what you're asking for is either this thing is going to go up another 100% or it's going to go down another 70%.
That's not true. That's not true because you get decimated on both sides, even if you're right on one side, but not like super right.
What do you mean? You would lose, like, let's say it moves. Let's say the cost of the position is about 10%, right? 10% of whatever your upward or downward gain is. Would it not be smart to just, like right now with NVIDIA, you think that, hey, you know what? I think NVIDIA is going to $500. So you buy a call option, like let's say a $400 call option, and then at the same time you sell $100. I mean, not you sell, sorry. You buy $100 put option, because now you're basically, that's what you're saying. If the binary outcome is in either direction.
Really, dude. I don't like. First of all, I would not buy a leap on Nvidia. I'd buy it on something else that I think is more alpha, which is the reason why I didn't buy Nvidia when the market fell down 20%. I was buying Astera Labs, I was buying Marvell, I was buying AppLovin, I was buying like a lot of stuff that outperformed Nvidia, and it did. Yeah. And well, the reason why is like that's what I would do. I wouldn't buy puts and calls at the same thing. But I see what you're saying. Like, why not just do a straddle? Like, like they were saying. Well, the reason why is because one, the VIX is at 18 right now, so the premium for options are a lot more. So I think, the
reason why I say that is because let's say right now, like you had right before earnings, you said to yourself, look, Nebius is either going to be going up 30% or it's going to go down 30%. Like you just said, you know what? This is a company that's either high growth, it's going to just shoot up, like crazy shoot up to either side because of where we are. Right now, we're in growth mode. That means that if they deliver on their numbers, it's going to keep growing faster. On the other hand, if that's
I didn't think they were going to go up like 30% from earnings.
No, but I'm saying, like, let's say you had 6 months out puts and 6 month out calls, right? Those puts would be printing so much that they would have outweighed your.
But like, it's just, why would I do that with Nebius? Like, of all companies, why would I do it with Nebius? I would do it with Bitfarms. Yeah, all right? I'm not saying that Bitfarms is a crappy company. I'm just saying like the chart for Bitfarms didn't look as good as Nebius.
The reason why I'm saying that is only because there's literally like the conversation that I have with like having with so many people, they're all saying this is either going to go to the moon or it's going to go down really
That's
fast.
not true. Nothing says that we can't just trade sideways for like the next year. And that's happened. That happened in like 2016, I think. For a whole year, we didn't go anywhere. In
Well,
fact, there's a lot that I'm not doubting that at all. Like that's why it's like, I mean, look at it this way: for like a month in September, like the market went up like 2%, but like, dude, some stocks went vertical. Like it's like,
the reason
yeah,
why
go
I
ahead.
say that, the reason why I say that is because you're looking at companies right now that have already gone up 400, some of them have gone up 400, 500%. So the expectations now are rather high, right? To keep this thing going, right? Like you've already got like a nice 400, 500% move. And a lot of it is based on speculation that this is going to somehow become super, super profitable, whatever. And no targets that it's going to go down. So on one hand, you want to be long. On the other hand, you don't want to be short, right? So what would be the most optimal way to play this? And in my opinion, it would be something like this, where you're basically trying to get as much upside and trying to get as much downside, from either move, because you think that the move is going to be exaggerated, right? I don't know necessarily know about this thesis on being flat, only because I've never seen like a company go from, let's say, a 10 PE to a 30 PE, and then it just lives at 30 PE for an extended period of time while the entire industry is kind of correcting, or the entire industry is growing really.
Well, how did you know the whole industry was going to correct?
No, but that's what I'm saying, that the risk is that you just said it, like, hey, this thing could eventually come down significantly.
Yeah, but I mean, this is my whole thing. Is like, why would I buy puts expecting the move to happen when like it's just not in my favor for it to happen? In fact, I do the opposite. If I play earnings, I sell premium. I don't buy premium, because you need a big move, and obviously when the earnings are up, the premium is going to be much higher. And yeah, it's like if I bought calls and Oracle before earnings, I would have made a boatload of money. But I think I played Oracle earnings, not the last one, before that one, where I sold in the money put credit spreads, which means that I wanted the stock to go up, and they were in the money, which means that I think it was like 15 strikes above. And I remember that earnings, Oracle was up like 10, 14%. And I was golden when that happened. And I didn't have to buy anything. I bought them back because I sold a premium and I made money off it. Like clearly, if I bought calls, I would have made a lot of money, but I would not have made actually that much money if I bought the calls, because the earnings premium made the IV higher. Right. So like for me, I think NVIDIA is going to be an option selling event, as it always is every quarter, but I don't play it because you never know that one quarter where like they're just going to SHIT the bed, or if they're just going to rip. Like I prefer not to mess around with NVIDIA when it comes to that stuff. But more times than not, after earnings, it's where market makers make money. They do it over and over and over and over again, and they win over time. Maybe they lose a lot certain times, but over time they'll win. But they have like models that they build out, which helps them figure out the risk they want to put in and so on, whatever. I'm no expert at that. It's just basically the equivalent of gambling, in my opinion.
I'm going to put some numbers to this, but I think the market corrects about 20% next year at some point.
Yeah, how do you know we're not going to be 20% higher?
So I think right now it's a good time. I'm not saying, oh my God, get out of the market. You're going to lose 20% of your portfolio, all that BS. But I do think that we're at a point right now where you have to protect your downside. And the thing is, the downside is something like Liberation Day, right? Like, I'm not saying that structurally you could have been like when Trump got elected and he was, whatever, all that stuff. Every year, there usually is at least a 10% correction in the general market. But right now, with valuations where they are, I think the market is a little bit more jittery, in that if we do get any sort of like bad news on anything, that we could see a 20% market correction. And that 20% market correction is where those hedges, they really do protect you, because you can basically sell those hedges at a significant profit and keep your portfolio steady, and then use that capital to buy the dip. So imagine right now we were in November, December, and we said, you know what, even though the market's doing really well, it's doing great, I'm going to buy some hedges going into next year. And April happens, market goes down 20, 30%. And now all of a sudden, you know, those puts that you had, they're printing, and now you could just sell those puts or buy those.
This is the thing. How do you know when to sell the puts?
Well, that's the problem, right?
Yeah,
You usually have to do it when the market is super, super happy and super euphoric. That's the thing. Like I'm telling you, a lot of people,
it's not going to work.
They think that you buy puts when the market is going down. You buy the puts when their things are going up, man.
I don't think that's correct. I think you buy puts when they're going down, because if you kept buying the puts as the market was going up, you'd be Michael J. Burry. Okay, like that's what you would be. Like, how do you know when the top is? Like it. I don't know. And second of all, history says that all-time highs are usually clustered. So all-time highs are actually bullish. Okay, so it's never the best idea to short an all-time high, because yeah, go ahead.
For me, I think what I'm gonna do, and this is just me doing this, probably around December, January, I'm gonna sell some of the winners that I've had over the last few years. And I'm not gonna sell like everything, but I'm gonna sell some of my winners that I've had. I'm gonna pay the taxes on it. And I'm gonna take that money and I'm going to buy up protection for 2026. Because I do think that we get at least a Liberation Day kind of event, in which case now I'll be able to sleep nicely, and you know, me and the wife will go to sleep happy. And if the market does correct, I'll clear out those puts and I'll buy the dip using the proceeds from that. And if let's say it doesn't happen, then I'll just chalk it up to, hey, listen, I have a tax loss write-off at the end of 2026 while the rest of the portfolio is just doing its thing.
You just right now, portfolio.
I'm just going to hedge the portfolio, because the thing is, like, the way that we're looking at these markets, the level of euphoria seems insane. The valuations on the general market are insane. And do I think that we get a broadening out rally? Yeah, I think that's the case. But I also think that there are times where things happen that can throw like exogenous shocks into the market that was not on anyone's calendar. Like, did you have Liberation Day on your calendar in January?
No, I absolutely did not. You know, honestly, the strategy that I employ has just been treating me just fine, because I've been able to ride the wave up. The only thing is that, like, Stock talk about this too. If you waited till we broke a 200-day moving average to buy your puts, you would have done just fine to mitigate all that drawdown, right? And you were there too. It was pretty clear as day of, like, not exactly when the bottom was, but when like the market was pretty much bottoming after the Liberation Day, because that was when you saw like a slew of downgrades across the board for the markets across all of these firms. And that's usually a pretty good bottom signal. Like when you have like the loudest bears in the market saying we're going to go lower after a 20% drawdown, like that's when you know, that's not no, but like that's when there's a pretty high probability we're bottoming over here.
I mean, and the CNBC are the, what is it? Markets in crisis. That's a never fail.
Yeah, like, no, that's useful, because that's when people tend to get scared, obviously. Yeah. And for me, and I did this last time we broke. I did this on I did this on Liquidation Friday. I bought put spreads for IWM. And I actually made 30% on those, right? And it was 3% of my portfolio. So like, obviously it wasn't a lot. It was 1% that I made off it. But like, well, we could have went down worse, and I would have basically 5 times those, and I would have covered. So 3%, 5 times, I would have covered like a 10% plus drawdown. Like, that's amazing. Like I that's phenomenal to cover a 10% drawdown, especially when I have a lot of high beta stocks, right? And especially then, like if there was further downside, I would have sold a lot of trades, and I would have sold it for a loss, and then I would have probably broke even had I employed the strategy. So I actually back tested the same strategy from last February. Yeah. And I think my max drawdown was like 25%, like some ridiculous amount. Like, I mean, we all got effed during Liberation Day. And I would say that was pretty good because I was doing some hedging during the time too. But can you believe like turning in 25% max drawdown to only to only like a 12% during that crisis, like how good that would make you feel in terms of that. And then being like that much more confident that you'll have extra money, like you said, to buy the dip. But if you hedged at an all-time high, like today, not today, today's a bad example, but like let's say when people thought we hit a top in August, right? If that's when you hedged with whatever you're saying and you sold it and whatever, you would have lost a lot of money on those puts because they didn't work. And on top of that, you would have missed out on a plethora of gains that we've seen since August. That's the reason why it's like, why employ that strategy like when we're already at all-time highs? You employ that strategy when we break levels. And then if we recover those levels, then just take them off. Just take off those puts. Because like I could have held those IWM put spreads, but I sold them because I was seeing that we were very strongly recovering the 50-day moving average. So I sold them.
Are you considering at least moving part of the portfolio into something that's outside of just big tech growth, or is that just like, hey, that's where I would look
at Fiserv? I need to look into Fiserv more. I have a starter on Fiserv, but I haven't really added to it because I just haven't had time. Verizon Play sounds pretty good because that's more of a safety thing. Also a lot of the setups that I have I'm not going to sell positions that are long term. Like I can't, right? Like if I would have gotten shaken out of Amazon,
you'd rather just stomach the volatility rather than
for certain companies, I'd rather stomach the volatility, right? But then there's other companies where it's like, I'm not going to bag hold this thing. Like, dude, if we break some moving averages, I'm going to sell Cypher. I'm not going to hold on to Cypher. I'm going to sell Clean Spark. I'm not going to hold on to Clean Spark. Like, I'm going to sell my Vikings Therapeutics trade, which is doing pretty well. Like, I'm not going to hold on to that one. Like, I'm going to sell like all my trading positions. That'll free up a lot of cash in my portfolio, and I'll have money to like, DCA into some dips and stuff. But you will not see me like buy the dip hard when we're like well below 200-day moving average anymore, because there were many times where I thought we bottomed last April. No, it was like March, and I injected money into my portfolio, and those ads got decimated. Right? Luckily, we came back, but I'm just saying, like, I could have waited. Like, and I don't want to do that strategy anymore because I don't think it's really going to work in the long term. But I think we should probably close out soon.
Yeah.
I mean, long story short, I don't think we had a freaking top. Like, this is bonkers. Hey, and if we are, guys, if we fade, if I wake up tomorrow morning and we fade, then it'll be time to open some hedges. And if we don't, on to the next one.
Actually, for me, I'm hedging for 2026, not necessarily because I don't think that there's more room for this market to run. I just think that the market right now has gotten frothy. Yes, there's the backdrop of rate cuts that are coming in that could keep equities valuations rather elevated nicely. But I think that there's probably more of a chance that we see this rally broadening out than the entire like collapse of this thing. Yeah. So I do think that right now everyone seems to be focused so much on Nvidia and the hyperscalers and that part of the market that they've basically sucked out all the capital / oxygen from the rest of the market. And there are a lot of great value plays out there right now that haven't necessarily got a lot of love, that deserve some level of attention. So as an example, like when you look at something like Nebius and Verizon, while Nebius has done well for a lot of people, the thing is when you're at a high point, if you correct 30%, that means that now just to get back to where you were, you need not a 30% move higher, but a much higher percent move higher. And so right now, if you had just been in something like Verizon, yeah, you didn't lose 30%. You lost, well, you didn't lose anything because it's actually up a little bit. So right now is the time, in my opinion. So if you still want to be long the market, just to shift away from a lot more growth to a lot more value. So I would say to someone who's like 80% growth, 20% value, it might be some time to just basically turn the value percentage of the portfolio to like 40% and growth to 60%.
We didn't talk about VG.
Huh? I'm not talking about VG. We didn't talk about VG.
I know.
Sorry.
We should have talked about VG.
I mean, I've done so many videos on VG, bro. I'm kind of getting
tired. You know what? There actually is, and I'm gonna put the link let me get the link real quick. Go ahead and keep talking. I'm going to grab the
Yeah.
link to the one you did with Matt last night.
even
That
if
was like all about VG.
Yeah, so even if you're not necessarily like, oh my God, I'm bearish on the entire market, I think the market is going to go down, 20, 30, 40%. There is a chance that we see more rotation into value names, and especially with rate cuts. If interest rates get cut, will there be a little bit of premium for the growth names? Yeah, but not like, oh my God. Whereas a lot of these value names, they have been caught up with a sudden rise in interest rates impacting their overall business model. And I think for a company that has like a 8 to 10 PE, if you cut interest rates by, let's say, 100, 200 basis points, their earnings actually shoot up rather quickly, and it's very impactful to their stock prices. So because they all have a lot of debt on the balance sheet. So just for me right now, I am about 40% growth and another 60% value. And I think next year I might actually even go as high as 70% value, 30% growth. And somewhere in that, maybe 5 to 10% of the portfolio is just going to be probably like hedges on the growth part of the portfolio, right? So it's going to be like 25% growth with 5% of that hedged for a downward move in the growth parts. And can I stomach the decline in value? Probably, because when it comes to value, you're not gonna move down that much more significantly because you're already trading at attractive multiples. So I think if value corrects, it'll correct maybe 5 to 10%, whereas growth might correct 20, 30, 40%, in which case you don't typically want to be in, like I said, it's all about portfolio allocation and sizing and where you want to be. So, that's just my take on it for 2026. Not necessarily, oh my God, I'm going to sell everything and go into cash, because no one ever makes money on just sitting on cash. But, having some good value out there is not a bad idea. So,
Yeah, these guys are right. I put VG in the title. Total fumble on my end. Next time we have a show, I'm just gonna put like 2 things on there, and then
bro, you
that's
need to
it.
get some more sleep, man. Your hairs are you're younger than me, and you're graying out quicker than I am.
Dude. This is genetic. I had gray hair since I was like 30 years old. Like, this is genetic.
Really?
Yeah,
Wow.
this is genetic. How much weight did you lose?
I am down from 210 to 178.
Wow.
So, yeah.
Some of the people were talking about in live stream was like, damn, where did Chris go?
The goal is to get to about 155-ish. Yeah, 155 will be the real goal. So we'll see what happens.
That's crazy, man. That's crazy.
You know what I can't believe with the comments sometimes? People think I don't have like real hair. They're like, oh, he's wearing a wig or whatever, or he's bald under the hat.
You got good hair. You got good hair.
I'm Indian, bro. I got that good Indian genes. Like, that's not a wig. Like, here, I'll lift it up. You can't, so I don't know why people think I have a wig. The reason why I wear a hat is because like I literally schlep out of bed, get up, and I'm like, all right, let's get on stream. And so sometimes I don't have time to like fix my hair. So I'm just like, all right, whatever. I'll just put on the hair. I'll just put on the hat. That's all.
Got good hair, dude. I'm a little jealous.
No, dude. Don't be jealous. I got hair in all the wrong places too.
Yeah. All right. That's a little. I gotta.
Not like stomach, bro. Get your mind out of the gutter. Get your mind out of the gutter.
Dude, I'm as hairless as you can be, dude. I have
got
gotten
that,
I got the Asian genes. I have zero hair on my chest. I have no hair on my chest whatsoever. Like, I mean,
you have no hair on your chest? Really?
I have hair on my chest. Yeah.
Bro, I'll show you. Look at this.
I don't. Jeez.
It's chest hair, bro. It's not gonna kill anyone.
You always have to do this like toward the end.
I don't have, one thing I'm very lucky that that other people, I don't have back hair. Like,
I don't have back hair either. My son has a very hairy back. I don't know where he got that from.
Yeah.
He has a very hairy back.
I don't have any back hair, which I'm shocked at, because actually no, my dad doesn't have back hair either. Huh. Yeah. I don't have back hair. I have a hairy chest and I have a hairy stomach, but no back hair. Yeah.
All right, so I changed the thumbnail. I added the timestamps, and that'll be it. Thank you all for joining us, man. We got 150 night owls in here, aka I don't know, not aka anything. We got night owls in here. We got people around the entire world. Appreciate you guys for joining. Yeah, we'll do this again next week, and we'll probably do a little something for the subs too. So
we should probably talk about
alrighty.
VG next week.
No, we should probably say we're going to talk about VG next week and then talk about everything but VG later on, just to keep people on their toes.
Gotcha, bitch.
All righty, guys. Thank you for hanging out. Talk to you guys later. Recording will be available, of course. Once again, Hidden Edge Podcast. Chris Patel. This is his Twitter account. It's actually on the bottom of his handle. This is mine. If you're watching YouTube, guys, go ahead and visit the channel, youtube.com/@thesolidfinance, and like and subscribe, guys.